Yields on U.S. Treasury bonds contain a hidden message that few people know how to decode. The message is about expected inflation and about the real yields that investors are currently requiring on securities. How do you obtain this message? And what does it mean? Believe me, you can't really understand what's going on in the U.S. economy or be an informed investor if you haven't decoded this. So today, we're going to do a deep dive into how to decompose the yield on the 10-year U.S. Treasury note and evaluate its two components, the expected rate of inflation and the real yield. It is absolutely essential that you know how to decode these two indicators because they influence absolutely everything in the financial system and in the economy, from mortgage rates to Fed policy, currency exchange rates, and even the fair value PE of stocks. So stick around, because I promise you that by the end of this video, you'll have a professional understanding of how to decompose the yield on U.S. Treasury bonds and how to use this information to understand what is going on in the U.S. economy and to help you become a better investor. And we will be presenting this material in a way that you probably have never seen before. So let's dive in. The 10-year Treasury yield is probably the most important benchmark for long-term interest rates in the U.S. and the global economy. It's a major factor in determining the cost of long-term credit, such as mortgage rates and loans for businesses that invest in long-term projects. It's a crucial financial and economic indicator. Virtually all long-term investment assets, including bonds and even stocks, are critically impacted by this yield. Now, as you know, a U.S. Treasury note is a debt security which is issued by the U.S. Treasury to finance the U.S. government. So the yield on this bond reflects the return that investors demand for lending money to the U.S. government for 10 years. This yield is composed of two main parts, an inflation compensation yield and the real yield. Let's break both of these down. First, let's look at what I refer to as the inflation compensation yield. What is this? To understand this, you need to think about what it is that as an investor you expect a yield to provide you with. The first and most basic thing that you want from the yield on a bond, at the very least, is to compensate you for the inflation you expect. When you make an investment in a Treasury note or any other typical fixed income instrument that has a fixed interest rate and principal repayment, the purchasing power of both your principal and interest will be eroded by inflation. Therefore, investors will demand a yield which will account for their expectations of inflation. We call this part of the yield the inflation compensation yield. Now, were you aware that it is possible for you to know exactly how much inflation is implicitly expected right now by buyers and sellers of bonds in U.S. markets and how much inflation compensation they're demanding? This is a very handy piece of information to know. How do we know what the inflation expectations currently are of buyers and sellers of bonds and how much inflation compensation they're demanding? In the case of U.S. Treasury bonds, the way we can identify this is by comparing the yields on a U.S. Treasury bond, which is a nominal yield, with the real inflation-protected yield that is provided by a class of securities called TIPS, Treasury Inflation Protected Securities. TIPS are a special type of bonds that are issued and backed by the U.S. Treasury, which fully compensate investors for any inflation that is experienced during the term of those bonds. Plus, they provide a real yield. In other words, a yield that is net of inflation. Now, if you take the current yield on the Treasury note and compare it to the real inflation-compensated yield on TIPS of the same maturity, you can infer the exact rate of inflation that investors that recently traded those bonds are implicitly expecting for the term of those bonds. This difference between the 10-year yield and the real yield provided by TIPS is referenced in the market as the inflation break-even. It's called this because it is the amount of inflation compensation yield that U.S. Treasuries are providing you to enable you to break even in real terms with the real yield that is provided by TIPS. Now remember that the inflation compensation yield only represents the implicit estimate of market participants of what inflation will be in the next 10 years. The actual inflation rate can be higher or it can be lower. If the actual inflation rate in the next 10 years turns out to be lower than the TIPS break even, then you will actually do better than breaking even in terms of total yield compared to TIPS. Now, if actual inflation turns out to be higher than the TIPS break even, then you will not break even in real terms with the real yield provided by TIPS. So when you are buying a US Treasury bond and any fixed rate bond, you are making a bet on inflation. And the inflation break even on TIPS tells you exactly what the inflation rate is that you are making an over or under bet on. Now, the inflation rate that is expected by market participants is not static. It changes over time. If market participants expect higher inflation, the TIPS break-even rate will be higher. If they expect lower inflation, the inflation break-even will be lower. All else being equal, any change in inflation expectations reflected in TIPS break-evens will cause bond yields and interest rates across the entire economy to go higher or lower. That is just one reason why it's so critical to understand what the break-even inflation rate is on U.S. Treasuries. It tells you how inflation expectations are changing, and it helps you to know why yields and interest rates are moving. For example, if you see interest rates moving higher, check to see if inflation break-even rates moved higher. If they did, then you know that the reason that interest rates moved higher is because expectations of inflation moved higher. If the increase in yields and interest rates do not match what TIPS break-evens are doing, then you know that it's something else that's causing interest rates and yields to move, and you need to figure out what that is. The second component of U.S. Treasury yields is the real yield. Again, the real yield is the expected yield on U.S. Treasury bonds after you account for the expected inflation. And you know what the expected inflation is by looking at the TIPS break-even. So how do you know what the real yield is? Simple. It is the current yield on TIPS. TIPS compensate you for any inflation during the term of the bond. So the yield that TIPS are providing is a real yield. So what information is being conveyed by the real yield on TIPS? It's telling you exactly what the risk-free real rate of return is in the U.S. financial system. In other words, the yield on TIPS is telling you how much risk-free yield investors can currently get over and above being compensated for any inflation. Now, you can certainly get more real yield than what you get from U.S. Treasury securities, as indicated by TIPS, but you're going to have to take risk to get that. Now, what I want you to see here is that the construction and decomposition of yields for all securities across the financial system have the risk-free real yield as their starting point. You start with this yield, and then you start adding risk premium to it in order to compensate you for risks that you don't have with U.S. Treasuries. So as you can see, because it's at the base of all yields, knowing what the risk-free real yield is in the U.S. economy is extremely important. Now that we understand what the inflation compensation yield is and what the real yield is, let's put them both together. The sum of these two is the yield on U.S. Treasuries. So let's do an exercise where we try to assess the fair value of a 10-year Treasury bond. Let's start with the inflation yield component. The question you ask is this: is the market implied expectation of inflation, the inflation break-even rate, embedded in the nominal yield in line with our own estimate of inflation over the bond's term? The answer to this question will provide you with the first part of your value assessment. So let's go through a concrete example. Suppose the 10-year Treasury yield is 4.25%. The TIPS break-even rate is 2.25%, and the TIPS real yield is 2%. At this point, the question is, do your inflation expectations align with the market's implied expectation of 2.25%? If you expect inflation to be higher than 2.25%, then your expected real yield on U.S. Treasury bonds will be lower than what you could get from TIPS. So it's not a good deal. Given your assessment of future inflation, the Treasury note appears to be overvalued, at least compared to TIPS, which offer higher expected real yield. Now, conversely, if you expect inflation to be lower than 2.25% in the next 10 years, then the value of the U.S. Treasury note is relatively attractive, since the real yield that you expect to earn will be superior to that which you could get from buying TIPS at current prices. Now, let's consider the second component of U.S. Treasury yields. If you believe that the real yield should be higher than the 2% in our example, then it will appear to you that U.S. Treasury bonds do not offer enough prospective real yield. Conversely, if you believe that the real yield should be lower than 2%, then Treasury bonds will appear to offer an attractive prospective yield. Now let's put all this together in order to calculate your personal estimate of the fair value for a 10-year Treasury bond. So first, take your own personal estimate of the annual rate of inflation over the next 10 years. Then add it to your estimate of the fair value of a real yield. If the resulting yield is greater than the yield currently being offered by a U.S. Treasury note, then it means that from your perspective, the Treasury note is overvalued. It's not attractive. By contrast, if your personal required fair value yield is less than the yield currently being offered by a U.S. Treasury note, then this means that the U.S. Treasury note represents relatively good value. It's attractive. I think you can see by now that understanding what the two components of U.S. Treasuries are and how to find them and interpret them can help you become a better economic analyst and make better investment decisions. Among other things, it helps you to understand what sort of investor expectations regarding inflation and required rates of real return are currently embedded in Treasury bond prices. The inflation expectations and the real yield component in U.S. Treasuries affects the prices of every single security and interest rate in the U.S. economy and even the global economy. In particular, the real yields on U.S. Treasury securities, which are the largest class fixed income securities in the world, are the foundation for all yields and interest rates in the U.S. and globally. But for now, we need to wrap up this video. And I just want to leave you with this one thought. As someone who has an interest in the economy and as an investor, you always need to be aware of what the market implied expected rate of inflation is that is currently embedded in the price of U.S. Treasury securities. And you also need to know what the real yield is. You need to know this. You can't understand what is going on in the economy, and you can't know how to price securities properly as an investor if you don't know what these two indicators are and how to interpret them. Thanks for watching. If you found this explanation helpful, please give this video a thumbs up and leave me some feedback in the comment section. Do you have questions? Are there certain topics you would like us to cover in future videos? Make sure to place your questions, thoughts, and suggestions in the comment section below. Most importantly, hit that subscribe button as we have some really interesting videos coming up.